Well, we cross over to Nairobi now, where Anthony Mwithiga, who's a Chief Investment Officer at Stanbic Investments, is standing by to preview Kenya's MPC meeting later today. Anthony, thanks so much for joining us this afternoon. Ahead of the MPC meeting, markets are split. To what extent are we looking at the potential of the bank starting to cut interest rates in your books, or is keeping them on hold more for probability?
Thank you. There's a strong likelihood that this afternoon the Monetary Policy Committee in Kenya will revise the CBR rate based on the happenings over the last 6 weeks. The CBR has remained elevated for three main reasons. One, we've just come from a rising inflation up to end of November last year. Now we're experiencing a decelerating inflation environment with a fall of over 150 bips year on year to end of February this year. Secondly, we've seen a more stable and slightly stronger currency, sitting at around 82.5 to 83.25 over the last few weeks. And then thirdly, there's a general feeling that interest rates have continued to trend downwards, as it is represented by the benchmark 91 Treasury bill rate. So putting all those three factors together, plus the pressure from both the financial sector, there's a strong feel that this afternoon the Central Bank Monetary Policy Committee will cut down the CBR signaling rate with a spread of 75 to 100 bips.
75 to 100 basis points. Let's take a look at implications if that does come to the fore, Anthony, because you've highlighted that we've seen inflation coming back a bit, and that's one of the reasons for a call like this. But that inflation rate is still sitting at 16.7%. So what kind of risk do we factor in terms of not managing to keep on that downward momentum moving forward?
Yes, I mean the Central Bank of Kenya, being the monetary policy agent of the country, has indicated that they wish to pursue an inflation targeting monetary policy other than the usual loose or tight monetary policy. The tightness was mainly driven by the wishes to strengthen the currency. Now that the currency has shown strong signs of stability and some strength, for them to be consistent with their inflation targeting policy, a revision is due because currently there's a spread of 16.7 on inflation and 18% on the CBR rate. So if they cut to the maximum 100 bips, that will bring the CBR rate to 17, which will be close to the current year-on-year inflation to end of February at around 16.7, which is also an average of around 17%.
We'll get to the shilling in just a bit, but factors to consider when it comes to that inflationary outlook moving forward is dry weather that persists over in Kenya right now, and then higher global prices as well on the oil front, which could put upward pressure on both food and fuel prices from here on out. So again, let's look at that risk factor and just how much risk you've got to be factoring in.
Yes, you're right. There's an implied risk from oil prices and food. You realize the two items, both oil and food, comprise just over 65% of the Kenyan CPI basket. Now, that's the risk we carry as a country. And with inflation easing off over 12 weeks, there's a likelihood that as a trigger on interest rates in either direction has a direct implication to inflation. So the risk of a turnaround is basically pegged on two items. One, the ability of inflation to continue coming down, and secondly, mainly driven by the ability of food prices and oil to remain down. We are strongly aware that oil prices in coming few weeks might turn around, especially if the currency is slightly affected. And I'm sure the Monetary Policy Committee is wary of that. And the currency to them is a more important item in taming inflation, which comes from imported oil.
So what's your outlook on that currency front, Anthony? Because, I mean, we had, high interest rates supporting the shilling over the recent past, and a rate cut would, many say, lead to a weakening of the shilling, as it could herald lower commercial rates moving forward. So what's your outlook on that currency front?
A cut of less than 100 bips to the CBR rate will have a minimum impact on the currency. And that implies the currency will stay within its 100 bips to 125 bips either sides. That's a spread of, I would say, 82.25 to around 83 and a quarter against the US dollar. And that is a fair outlook, at least by the end of first quarter of this year, which is only 3.5 weeks away.
Yep, looking at commentary out of Finance Minister Robinson Gitai last week, he had stressed that, or instructed rather the central bank to prevent the shilling from strengthening beyond that 82 mark. You mentioned earlier that the bank is looking at other options as opposed to just, monetary control or monetary policy control in inflation targeting. What options are we looking at, Anthony?
The announcement by the acting finance minister at a cap of 82 shilling has been viewed variously by various financial market players, but more principle is that it is an indicator that government is keen to have a balance of a stable, strong and a weak currency. The spread between 82 and 83, maximum 83 and a half, seems to be something they are ready to live with, balancing the interests of both importers and exporters, and with the likelihood of a continuous downward trend in interest rates, the pricing of money market instruments like treasury bills and bank deposits, we expect them to reprice accordingly as inflation eases off. The outlook for inflation remains a downward trend, but the current management of the currency will remain a key factor to us having a falling inflationary environment, at least in first half of 2012.
Anthony, let's leave it there. Thanks so much for your time this afternoon.